Hello, my name is Nya-Teach-E, your teacher. We're going to revise financial statements. These statements are also called final statements. Final statements. And they are prepared at the end of a trading period. These statements will help us know the profits and losses that the business has gained, and also to know the financial position of a business, so that if the business owner or owners decide to get, say, financial help from somewhere, they will know whether it is the right time to do so. These financial statements include trading account, profit and loss account, trading profit and loss account, and the balance sheet. These four are what we refer to as financial statements. What is a trading period? This trading period is also referred to as an accounting period. An accounting period. This is the duration through which trading activities are carried out in a business before a decision is made to determine how this business is performing, whether the business is making profits or it is making losses, incurring losses. And this period can be as short as 1 week, 1 month, or even 6 months or a year. Most businesses regard 1 year as a trading period, most of them. At the end of the accounting period, some of these activities take place. For example, all accounts are balanced off, and then you are able to extract a trial balance. We'll learn what a trial balance is, and then the profit or loss of this business can be determined. And finally, you are also able to prepare the balance sheet. So how do you determine the profit or loss of a business? When you sell above the buying price of a good, we say you have made profit. If you sell goods or a particular good at a lower price than what you acquired it, we say you have made losses, or you have made a loss. So if you sell above the buying price, you have made profit. If you sell below the buying price, you make a loss. These two are what we refer to as gross profit or gross loss in accounting. And gross profit can be found when you look at the trading account. Net profit can be found when you prepare a profit and loss account. What is gross profit? This is profit realized before taking care of expenses or deducting expenses that were incurred while selling stock. What is net profit? Net profit is realized after deductions have been made of all expenses. There are adjustments that you make when you're calculating gross profit, and we'll look at some of them below. Number 1, return inwards. Return inwards or sales returns. You have sold goods and then they are returned by the customer for one reason or another. We call this sales returns, and they affect sales. So how do you get them? Net sales is realized when you take sales minus return inwards, return outwards, also called purchases returns. These ones affect purchases. They reduce purchases. What are they? Return outwards are goods that have been returned by the business after purchases, returned to the suppliers. So how do you get net purchases? Purchases minus return outwards. Drawings. When a business owner or business owners decide to take goods from the business for personal use, we say those are called drawings. We subtract them from purchases. Carriage inwards, also called carriage on purchases. This is a cost incurred by a supplier to transport goods to their customer. For example, when you buy gas from a gas supplier and they decide to bring you the cylinder to your house, we call that carriage inwards. That cost is incurred by the supplier. So it is usually added to the value of purchases. So what are we saying? Net purchases will be found when you take purchases, that is what you have bought, plus carriage inwards, this cost, minus drawings, what what business owner has taken from the business for personal use, minus return outwards. Carriage outwards, also called carriage on sales. This is the cost incurred by the business, this one that we are assessing how it is doing. The cost incurred by this business to transport goods to its customers. For example, if we are selling Tumba clothes and we are in Kahawa West and we want to take our goods to town, Nairobi City, the cost that we will incur to transport our clothes to town is what we are calling carriage outwards, and this is viewed as an expense, therefore it will be subtracted from the gross profit. Then we have opening stock of goods at the beginning of a trading period. Closing stock is the value of goods, stock of goods at the end of a trading period. Therefore, how do we calculate gross profit? We take sales minus return inwards minus opening stock, which is opening stock plus purchases plus carriage inwards minus return outwards minus closing stock. It is simply net sales minus cost of goods sold.